All right, let's take a look at this. You see the bears got daily tension. Hold on. The bears got that tension down. Daily tension under 0. This is a big deal. The bears pulled it off. So yesterday, I was wrong. I was looking at this thinking that the bulls were going to keep this moving up and we get tension up, and the next event was going to be 30-minute tension hitting 0. That's what I was expecting, because that's the behavior we have seen for weeks. So they broke the trend. The bearish window that cracked open a few days ago when the bears were able to accomplish some things over the bulls, which was 2 trading days back, Tuesday, has slowly been making its way in, and the bears have finally pulled it off. They finally got this under 0. We see in the morning tension peels out to the downside. You see that? So just overall, we can see what... I have to turn off this video because 5-year-olds cannot resist the camera. So we see that tension moved down. We have a good baseline for what... You can't hear me? You can hear someone and not see someone. It's got nothing. Okay, let's take a look at the events that happened this morning. The first thing that happened, we have most of the trading world should have noticed. We had velocity pop down. This is at 9, so it was about negative 20 at the open here, and hung out around that area. Well, negative 30, I guess. But this is the 20 level right here, this little dotted one. So it hung out around there, pushed down, and that's basically it. The decay pops up, and we don't get trapped orders until a little bit later after it pops up. Very unorganized. So the structure here, not nice and clean. I like the signal to line up really well with the sample. The sample and the volume to line up to make a signal. And we could see that they didn't have anything really until here. And that's it. That's all we have. That is all we have. So the question that you're going to have to be asking yourself, which is a tough question, is this teeth? And this is one you need to always bring up. Is this just pressing stops? Is this, oops, I pressed a button. Okay, there we go. And looking back on this chart here, which maybe I just need to make this chart a little bit wider because I keep scrolling back to point out things that have happened. You can see right here, notice what today's low did. Here's our origin position. Here's our root 1. Here's root 2. And do you see the pattern that happened? We had the market dip down as teeth. I'm just going to mark this with a T now. And it pressured this, pushed right back above it. And then overnight, we liquidated all the people who decided to hold. And now we're pushing down and pressuring the first root position. And so the question is this teeth? Is this just pushing against all the bulls who have tried to pick up these lows and try and make this into a range that's going to break out higher? Or is this the bears successfully taking control of the market? Well, there is a big difference about today than there was last time, and that is daily tension is down. This is extremely motivating for the bears. They have control of probabilities. They took it out. Now, this is not a market, a trend cap. Now, I want to pull this up. You guys, I tried to come up with terms for all these things. So let me show you. You come into the Trade Trust Group website, and this is going to look different on mine. Maybe I should bring it up. I have some extra features here. Just don't worry about those features. That's so I can add content. Okay, so in here, in this tension page, you can scroll down. You can see, you see all these? MTFR, zero test, ERB. These are all features of tension that you can look for. And when I say trend cap right here, this is what trend caps look like. Trend caps like to cross both at the same time. This is not quite that. And trend caps a lot of the times will signal the end of a trend. If we scroll back a little bit, we might be able to find one here. Here's one. In this case, it didn't because it got reversed immediately the next day. But this is a signal that you need to pay attention to when they happen. Both cross down. And so they're both down, but it's not quite a trend cap because they didn't both flip at the same time. But they are both down for the first time. So I don't really have a term for this situation. You guys come up with one and I'll use it. But it's after a long trend, both are down together. Okay, so that's the situation we have this morning. And I want to talk a little bit about psychology. I know we do this all the time, but it has to be discussed to understand where the market is right now. This is the finish line. Whoops. Is there two ends? Oh my gosh. I'm just going to write what I think. You guys can read. Finish line. The finish line is a situation where a long-held objective is finally achieved. And you don't want to try to participate. Don't. In the victory lap. And a victory lap is after you win, you just sort of run another lap. Not really running, if you're a runner, you run. You're like, yeah, and you almost make it all the way around again, just, so your fans can see you. You do not want to participate in victory laps. So this morning, the Bears finally achieved all their hopes and dreams. They're taking a victory lap. They were able to get all of tension down. You have to be careful about this. This principle, it will resonate across all trading strategies and analysis. Victory lap is essentially a pullback after you achieve all the stuff you're trying to achieve. So if you're trying to break a level, you're trying to do this, that. Once you get that victory happen, markets they pull back in a victory lap. Now, there's a more mechanical reason for it, but emotionally you need to remember that when markets are victorious, they like to draw back up before they move on to the next thing. Did you eat up all the food I gave you? You eat that up and I'll give you some more. So we're in victory lap territory. They got everything they wanted and the market's going to get, and they're going to, we get a little bit of that going on. So remember that victory lap philosophy. It's the finish line. They hit that finish line. Okay, so the next event to happen here, which the only thing we have is these bears, who we're going to have same as before. They're going to have their stops, somewhere up here, probably just here. If you're a more conservative group, you're going to be up here. Personally, I would feel like if I was in a position and it popped up, they're going to close the gap. I wouldn't want to hold for that, so I'd liquidate before. You'll notice yesterday's short is here. Yesterday's major long is here. Those are the only ones I hung on to in terms of like marking out. And notice today that the long was really what has been a significant level to be at. These longs are being pushed under their position. The market doesn't want to go above it because they'll become liable to pay out those longs, and they don't want to do that. So this is an okay measure to show you that there's still longs sort of hanging out here, and the market has found a way to cover those costs, and it doesn't want to be liable for the bulls. So we have those guys out here. And you'll notice that that's all it's done. We really haven't had anything else. So if you were trying to figure out what's up with the low, nothing. I have nothing in the lows. There's just nothing going on here. It pushed down and then momentum turned back up and it came back up with momentum. There's nothing going on here. The only thing we have is these bears right here, which means these bears, it's popping up right now. And I'm like, so we got to get through this quick. These bears are the only bears here, and therefore they are liable for their own position. But in a longer term time frame, we have the bulls here who are, the market has found a little bit of liability for them. But on an intraday level, it tends to be that when stuff like this happens, this position gets insured. And so we can't really pay attention to that one a whole lot today, even though it has created a little bit of structure today. These guys on intraday level have not been able to ensure their positions, and so the market's going to push up and try and liquidate them. Once the market liquidates them, it's going to have to reestablish some positions. We have the bears coming in here. I'm sorry, I'm trying to move fast because it's happening right now. It's gonna move up and it's gonna look to liquidate those positions. We're gonna see the liquidation happen when tension starts to curl up. Tension starts to curl up, then you want us to take a look for more bears to come in, see if they can reestablish themselves and pump the market lower. But in order for the bears to pump the market lower, they're gonna need to catch bulls. So we're gonna have to move it up, capture some bears to come in. We're gonna have to move it down, capture some bulls, and then they'll have to turn those bulls upside down. And as they move down, they're going to pump tension. That is the route that these guys are going to have to take. This is how it's going to work. So we're pushing up right now. We're going to pressure these bears at wherever their stops are. And I'm going to go ahead and mark those stops on this chart. And hopefully you guys are realizing that this is actually a pretty, even though it seems really comprehensive, it's actually a pretty repetitive style of analysis. The same things happen every single day over and over. It's just that those things are difficult to program, and that's what makes them an effective, repeatable thing. Do you see how this is happening? So we're shoving up right now. They're pressuring the stops. You can see that pretty much a lot of those people just bailed right here. So that's still about where I think the stops are going to be at. But you see tension curling up here, and we have a sample happening at the same time. So moving forward from here, these bears need to trap some bulls. All right, I think we pushed through that. So I know it's fast, but it's going on right now. So you got to be able to keep up with the events. The big problem is these guys got lonely. There's nobody there. They pushed the market down. They had nobody to trap. There was nobody here, and this is a mistake. You can't trap nobody and push the market down. And previous day positions they don't work as a trap because, multi-day positions do things over time to hedge out their risk and position themselves. So that is not an effective group to trap out. This push right here is cash. Let's see from your school tablet? Yeah, but you got to be over at your desk. Okay? This is what they're giving the kids at school these days. It's brand new. Just brand spanking new, right out of the... All right, this is from bears. They injected capital, their hard-earned cash, into big, large positions. That's what happened. That's what this group is. This cash failed to catch bulls. Okay, and we can see that through the data. You're thinking, all right, you guys need to catch some bulls. Can you guys hear the tablet? Do you hear that music? Hey, turn that down a little bit. He's got a little desk and he's supposed to... Okay, here we go. So they pushed down and they didn't catch any bulls here. Okay, so when we look at that, we can see that these bears popped into the market and they did their very best to shove the price down and they could not capture bulls. So this push down here is different than something, say, like this, or maybe a different day or a push up, where they're pushing to catch a loser. They're trying to call the bluff. They're trying to tempt someone, anything, but they just couldn't pull it off. And this is a big, big problem. And we've seen this exact behavior before from the bears where they fail to capture. Maybe we could take a look here. Which day was it? It was this day. Isn't this day? It was this day right here. This day, these bears came in and they shoved the market down. And I think it was this day. And they pushed out chart for some reason. It's like it's still loading in data, but it's not. I don't know. They pushed the market down and pushed out their competitor too quickly. Okay, this is where we are. They couldn't pull it off. So there's a little bit of failure here by the bears. This is starting to, that window that cracked open earlier is now shutting. When you start to get failure by one side of the market, and I know the market's popped up. Don't get excited. Don't chase. You need to be trying to participate in this earlier, and I'm sorry I should have gotten a little bit earlier. I had to rush to get through all this analysis to help you see how this worked, because my goal is to help you see how it worked. If you can understand how this worked, and essentially they didn't catch anyone here. There was nobody to trap out, and that makes them the target. That's really the big issue. So this huge shove down is working against the bears now. They've created some upside force, positive 41% intention, and then as this curls up, we could see them, a lot of people dumping their positions, but I'm still expecting it about here at this price, about 39,391 is where I think the initial stops are sitting. And then there's going to be another group of conservative traders here. Of course, they're always going to use the previous day's highs. It's just, the reason for that is because it is so optic. It's so easy for everyone on planet Earth to look and see yesterday's highs. And so of course there's stops there, but the more cunning of the group is going to have theirs about here, realizing that there's going to be gap traders who come rushing into this market at 100 miles an hour to close this gap. They're going to go, oh, let's get in here to close this gap. And so these are things that are weighing on the market right now. All right. So now that we have a little bit of failure by these bears who popped in this morning, and we kind of know where their stops are, and we can see why they got turned upside down, we could take a look at what's coming up next. The next thing on this, you could see that we have a +4 on daily tension. Now, if this continues to rise up here and hits some stops here, and it goes all the way up and it decides to close the gap, I imagine this +4 is going to look more like a +1. And that means daily tension is going to close like here. And this is a real dangerous spot because the origin of the bull's position from a few days back is still intact. They pressured it, they pushed, they failed. And not only did they fail, but in these lows, they failed to trap any bulls at all. So this is a very confident bullish position out of these lows, the major lows. And the major lows right now, in my opinion, are the lows that got established back on Thursday. Is it Thursday? I wish I wouldn't go so far. There we go. Wednesday. I apologize. Wednesday. These Wednesday lows are the ones that matter to me the most. This is the origin position. It was, after I call it an origin because we had a whole trend up and then we finally had a pop down in a new range situation set up and the bulls were able to get an origin. It's held together. So these bulls are in a confident position. You can't seem to trap them out. So this looks to me like a retest of some major lows. So over time, I'm anticipating and I'm looking more to the upside. Now I am having to keep in mind that this is negative. This is our daily tension's down. If the bears come in and inject like this, if they inject cash, they're going to have an easier time running the market. The problem that they're having is that they seem to be, let me just write this, bears seem to be the counterparty. You inject capital and you can't take out the lows? Do you have to ask for permission? Do they have to ask for permission? Do the bears have to ask? Is this a big deal? I mean, if you're in a group of people and you want to, I don't know, renovate the kitchen, if you don't have to ask anyone, it's because you're in charge. If you have to ask, you're not in charge. And if you're married, really you should always ask the other person. So there's two people who are in charge and they always ask each other. And it seems like a fair compromise, right? So if you're having to ask to do something, you're not really in charge. And since bears and bulls are not married, it's the one who's doing the asking is the one who's subordinate. And I think the bears are acting like the subordinate, and that makes them the counterparty. That means the main trend is not down. It's not down if the bears are asking. If the bears have to push this down with all their might and the bulls say no, well, only the dominant party can say no. So bears, sorry, they did try. This is a hefty try. This is a $500 million try. That's what this is. Just remember that tension is a broad market calculation. It does not look at little tiny things. This is a massive attempt to push those lows, and it failed. the big boys came in and gave it a hard shove, and they didn't get it. This is bullish. It is bullish on the long term. It is bullish. We're not heading down, at least right now. Until the bears can establish their format of dominance, we did have a little bit of progress, and I think that was it was here, in this area here. And the bears came in and took advantage of that and did what bears do best, which is destroy every bear possible and then drop the market. Destroy every bear possible and drop the market. That's what bears do best. And again, they popped it down. So their window opened up here and they got it down, but it shut again. I'm sorry, it's shut. It's psychologically, or I don't know, hierarchically, it's closed. So what if the bears want to establish their dominance over this market? It's not going to take a signal. It's not going to take a little pumping. It's not going to. What they're going to need to do is establish a major position and not just get some teeth out of it. You see how that looks just like a tooth? They're going to have to take out a major position. And doing it the next day is tough because usually major positions rally up and allow the opportunity for insurance. So that's what makes them so hard to knock out, because they're insured. This is a big deal in markets. You want to capture enough profits in a trade to use those rotating profits to pay for the insurance so that you're at a net loss of zero, nothing, no matter what. And then nobody can take you out. It makes it very difficult to knock you out of the market. I would say impossible. So they pressured that major position here, and we see. So I'm trying to spout off a little bit of this theory that I have about how you determine the major trend, and there's a lot to it. And in this case, it's who's dominant, who's pulling the strings, who's calling the shots. And this low here looks a lot like the bulls from a while ago called. Now, we do have one problem, okay? This is a big issue. Both sides, so both bulls and bears love. Thanksgiving. They Valentine's love. That was like they Valentine's love. They just love it. They write cards to it. Positions at or very near extremes. Sorry, daily extremes. They love that. You do not want a bull position. It's 50 points off the low, or 30 points. 2 or 3 points off the low is okay. But they just love them. I mean, the bears pick up position here. They want those positions right in the extremes. It's problematic having a position that's not in the extremes because it suggests that on the intraday volume, there are orders that are more favorable and therefore have a little bit more rotating profitable power than you do. It's not usually a big deal. That's why a couple of points is fine. But if you're in 1,000 points or 1,000 contracts and markets short and markets move down, you have some percentage of rotating profits you can use to your advantage. But if there is somebody who has 1,000 contracts above you, then they have more power than you do. They could shove the market back up to you. It's just sort of the way the math works. You want to be the highest one in the day, so you have pretty much the most power and impact in the day. So they really like to be near the highs and the lows. We don't have anyone in today's lows. This is a problem. It doesn't change the fact that the bears have had a difficult time flipping this over at all. What it means is that these guys this looks like a prospect to me. So picking up the lows, getting a position in there, which I hate saying this because, I'm like, it's bullish. And then to say something like, well, they're going to want to get a position down here in the lows before that they run the market up. And that's what I think is most likely. They want those lows. Bulls don't want to miss those lows. They're holding the root position from a while back, sure. Or an origin position from a while back, sure. They tested out the root positions, but they're really going to want something down here near these lows. There's just nothing. I don't see any liquidity getting generated here or here. So yes, we've established the bears are going to get wiped out. Yes, the market is hunting their stops. And yes, I think the market is bullish. And yes, I think we're probably heading up. And sometime between now and a few hours after the market closes, I think the market's really going to take a serious look at wiping out stops and maybe even going for conservative stops. But I can't ignore the fact that the bulls are, there's this big juicy low over here intraday that doesn't have anything on it. And that looks really good. It looks really good. The bulls are going to want that. They're going to want the lows. Most of the other days, pretty much every other day, we have spots where at some way or another, the bulls were able to generate liquidity and capture someone on the backside of their trade. That's how it all works. So yeah, I think the market's going to be taking a look at the lows before we have the fun. Maybe up to these highs, I think would make sense. We pretty much got up here, and we got to get up a little bit more. Maybe, we could see right here that a lot of the bears let go of their positions. So I'm guessing that a lot of these guys already dumped as it pushed up. So this stop may have been a little bit too high just because we can see that they dumped here. So it's like, oh, well, in that case, I guess it was a little bit off, but that's okay. That's okay because we can see it actually right here. All right, we have a bearish sample here that finished up, popped through, and we had some volume after it. So we got a bear here, we got a bear here. Still no bulls. Where are the bulls? The bulls would be decay makes its way down to 0 here, velocity here. There is no prospect on tension to generate bullish liquidity. So we could get signals there, trapped volume. We could potentially push this through if it did. Last ditch effort to give us a multi-day decay retest could sample some bulls. So these are the locations. This is where the bulls are sitting. They're sitting at these samples. And there is work to be done to get to bullish positions that they could come in here and try and take advantage of the circumstances that are going on. Okay, so this is where they're sitting. The closest one, and therefore the least expensive, is this one. So I think that one's the most likely. I think velocity is going to move down, give us a bullish sample. We get the bulls come in and do a little playing here in the market. We're going to have to keep an eye on those bulls, though, because remember, there are no bulls in the lows. I did not see liquidity. And that puts pressure on it because the bulls want to pile in a bunch of positions here and try and pick up orders in the lows. Okay, where are the bears? We already have bears in the market. They're trapped in. The only way to accomplish any bearish position would be switchbacks. So shoving through, going at that. Another bearish position could be if this shoved up and gave us a multi-day decay retest. So this is probably the most likely one. And then at that point, you'd have to ask the rules for a multi-day decay retest. Is this their only option? Yeah, I guess it could be. Have they shown that they really want to play? Yeah, they have. We have seen that absolutely out of these guys here. The bears absolutely want to participate in this market, and they're willing to try. So is this a legitimate position? Yes, I think it checks all the boxes. If we got up to a multi-day decay retest, it would be a position that I take very seriously that the bears would be interested in trying to take advantage of. In other words, I think it would work, at least over the short term, couple of minutes or at least 30 minutes or so like that, time frame. We would see the bears trying to capture a position there. Okay, we've gotten through where the bulls are, where the bears are, what they need to accomplish. Now I want to take a look at something else that's a little bit unique for today or ever. Let me move my head. This is a ton of options. Just like they're just stacked up. Like you can't even zoom in and look at. There's so many of them. Both the calls and the puts. This is a lot of option activity. It is way more option activity than we usually see. And I don't have a ton of experience with watching direct volume because I've only had this indicator built up in this mock proof of concept version that I've been using for about 2 weeks or so. But I've built a couple other tools, taking a look at volume. This looks like a lot of option activity. Just a lot. You can see this is kind of normal. This is pretty normal for a day. This was the previous day. And then right here on this line, this is today. It's like somebody just took white out and just both the calls and the put. So just general option activity today is pretty dang decent. That's unique. Don't see that a lot. Let's take a look at the broad market a little bit over, just a general view about what's happening out there. Boring, interesting, boring, hard leaning, but not really all that great. Very interesting. This is a big deal. It's pressed way outside of the bands, and we already had a big event, and then having it do it again. This is extreme. This is extreme. I guarantee you this has the eyeballs of lots of banks. You don't get this kind of stuff. This just never happens. This is a massive big deal. This has gone back to sort of boring. And soy's back to being boring. So really what has captured the eye of the market here is interest rates and Bitcoin. Job, Bitcoin. So interest rates, of course, have a lot of impact on the way that you can generate open interest and your margin rules. So they definitely will impact the way that the market is structured together. And Bitcoin, of course, is cash that is free from economy, but not really. Economy being something that is within a government and a body of people. That's my debt. So you get into the Bitcoin and you're free from any particular government, any particular people, any particular currency, and you can, you're free from that. And so I think a lot of economists probably view cash into Bitcoin as something like cash out of. So if you have the dollar here, it's like it's leaving the US more than the dollar. It's like leaving the country almost, but it's not really. Which is an issue because when you switch over to a Bitcoin, you give back, you create supply. Just like you have a dollar, you give the dollar back, there's too many dollars. And that's going to put a downside pressure here on the dollar because they say, I'd rather a Bitcoin than a dollar. They do that unless, of course, it is that your broker, which I think would be wise by the government to say, you must hold, like, I don't know, 150% cash. Because then it's like every time you buy a Bitcoin, you buy in $100 a Bitcoin, they create an upside demand for $50 more. So they're going to, every time you buy a Bitcoin, it should support the dollar. That would be a wise move by governments. Yeah. Force demand out of the US dollar. You have to hold a surplus of cash for every Bitcoin that you own, which sure, that could work. But currently it looks like this is a setup that's creating supply for the dollar, and it's helping to keep the dollar from shooting up or moving up or whatever. I don't know if there's some pressure to move up, but that's what this looks like to me. It also gets its way around regulatory agency, and this is where the too big to regulate could become an issue. If Amazon starts letting you pay in Bitcoin like in a major way and people do that, it's really hard to regulate that. Okay, so this, I'm only talking about this not because I think it's a big conspiracy or something. It's because Bitcoin has managed to gain it's the sweetheart of the market right now. It is what everybody is looking at. It is, and I could tell that because of the pattern behavior here. It has broken out of that pattern twice. And so this has the attention of the market. It is the most interesting thing you can look at right now across securities. That and interest rates. So are these related? I don't know. I have no idea. But I think that Bitcoin has some really big implications that we still haven't quite seen yet play out. Right now, it's following the popular rules. And what is popular rules? High school rules. If you're popular, you can do whatever you want. If everybody looks at you, you're on top. So it's following popular rules. Its volatility is equal to its popularity. The more you forget about Bitcoin, the more it goes down. The more you care about it, the more it goes up. It's just popularity rules. And of course, Elon Musk, who is the prom king, looked at it. So everybody did what he did. Monkey see, monkey do. I know. Tesla's the one who bought into it, but who gives a crap about Tesla? You don't type TSLA because you want to look at Tesla. You type TSLA because you wish you could type ELON and just trade this guy, but you can't. So this is just the avenue into Tesla. People don't buy Tesla because they care about Tesla. Nobody cares about Tesla's earnings. Nobody gives a crap about it. You buy Tesla to get a little tiny piece of Elon and all of his money. If I was to buy a Tesla share, it's because I'm interested in things like Neuralink. I'm interested in things like Starlink. I'm interested in these other, it's just there's no other way at the guy. So I think that is the reason that the short float got blown out in Tesla. It was because they thought Tesla stock had anything to do with a company that makes cars. Tesla stock has everything to do with it's the only way to trade Elon. Otherwise, we'd just trade Elon. I guarantee you if I called Elon Musk up right now and said, Elon, I got $100,000. Could you please use that to invest in your companies and stuff? And he'd say, shut up. He just hang up on me. He doesn't need my money. We can't buy Elon. We want to buy Elon. We all want to buy Elon, but we can't get Elon. Nobody can get their hands on the guy. Except for that woman who managed to have a child with him. She got her hands on the guy. Good for her. Okay, back to this analysis. So not a whole lot of progress here. This is a slow day. I'm defining the speed of the day by the activity. And there was 2 positions, and that's it. Not a lot of activity going in here. They're just, in terms of progressing story, narrative, what's happening, not much. The most interesting thing is the options pile that has just piled in. And I scaled this, remember, so this is the beginning of the day right here. So it was a little bit different last time we looked at it. I just want to make sure you see that. There are hidden, you can't see, hidden orders there. This right here looks to me like a hedge, but I don't have positions in the lows. So what are you hedging? I have no idea. Then we have calls about the same place, about the same time, potentially a position that's trying to just capture volatility. They're like, oh, volatility is about to rise and price will go straight up or straight down, doesn't matter. But it looks like they're biased a little bit here with calls. Are they shorting calls, longing puts? I don't know. That's about it. A little bit here. But again, I'm not all that interested in out of the money as much as in the money because these are way heavier. They cost more in terms of capital. So yeah, I mean, this is the most interesting thing in my opinion out of this whole deal, other than the general heightened activity. Which suggests to me that, let's see, that happened here because there's so many options I can't like get a reference on price. So is that 13.19? Look at that, 13.19 right there. That's where the options was displayed right here on its way up. So this sort of, the way that I'm interpreting that is that the market now has a problem. It's going to have an issue with liability. Somebody hedged something with puts, I think. Excuse me. And there's liability down here. Meaning now that they're insured, the market becomes liable to pay out. In other words, the lows are going to have strength in them because the market's like, well, we need people to trap. So there's a little support here coming in from the options world. Hey, that's a great way to define a support. Not the strongest support though, remember, because we don't have a bullish position. If I was able to put a bullish position right there, I'd say this is not breaking out your lows. But since I can't, there is just some general support coming in from the options market as somebody seems to have insured the lows. It seems to me that this big fat gap down right here has to do with a flurry of activity. This L is going to have to be taller. I don't know, a flurry of options trading, this stuff. For some reason, I don't know why people decided that today was so important to just fill a whole bunch of orders. It's really a big deal to do it today. Let's take a look real quick at the overnight session. I thought this was actually kind of interesting. Last night, the market pushed up and literally right to where we had bears conservative stops. You remember yesterday into the close, we were thinking, oh, their conservative stops are going to be sitting above this pivot here. Drew the line, and then overnight the ES got like right to that. That's what it did. You see, right to that. Or oh no, that's there. We got to the right to that. Okay, and then or the overnight highs it pressed. We had some stops there get hit, and then it just went sweep. This kind of thing down, and we worked our way down, and this just looks like somebody was really pushing to get us down. It's just lots of sweeps down. I'm not sure what happened. Not interested in the news. I like to look at the analysis before I go figure out why the analysis happened. But there was some pushing last night, and then the insurance policies this morning. And I think the big reason for a lot of the option volume is probably daily tension was down, 30 was down. So the probabilities over the next couple of days were looking negative. And so you want to insure your positions. And there are a lot, and I mean a lot of people, if you look at the charts like this, who have been trend trading for a while. This is a 4-hour chart. So there are a lot of trend traders who, when they see this kind of thing, are going to pick up insurance on their positions. And I think that's what's happening here. We have a lot of insurance plays going on, people who are concerned about keeping the profits they have and maintaining that they can get more if the trend continues. And I think that this is what spooked people. It was this whole situation. Okay. All right. Those are all my thoughts about exactly right now. Your goal right now is to create an expectation. And expectations tend to come in the format of limits and events. Hopefully you've picked up on this. The limitations would be, well, I'm not really certain that we're going to break out the lows, so I'm going to put a limit about here. That's going to be my limitation. And this is also a model for possibility space. You are talking about possibility space when you talk about limits. That is how you begin thinking in possibility space. You say, well, we're not going up to here and we're not going down to here. Here is your possibility space. And then you can create a probability map within that possibility space. I think the most important feature of possibility space are the limits, because this is your initial data point. If your limits are wrong, your possibility space probabilities cannot be accurate. Bad starting point, inaccurate data. So your limitations are important. And I've established that there is some support in the lows limit, that we have essentially an upside target limit, and we have our possibility space. You see, that's sort of the way you do it. So it's limits, events, and the events are going to be how you move around that possibility space. And so my version of expectation here is, well, we need to capture some bulls. We figure out where the bulls are. And this is the way that I think that we could move around the possibility space. We get a bullish sample and we can move up and take out this, but we have to remember that the lows have no trades. So that's going to bring down my expectation for how low the bullish sample could be down here, could be a little lower. So hopefully you see it create limits, and then you create events to move through your possibility space. That's how you build expectations. And as long as the market continues to do that, if you think of possibility space as two limits, an upper and a lower, over time, well, time n, time moving this way, essentially the line of least resistance, which is a term that we all picked up from Livermore, but it is a perfect way to describe it. So I don't actually mean this. I mean it in the sense that Livermore meant it. The easiest route is if your possibility space, suggests that it's easiest to do this, then you find a trader. It's easiest to do this, and you find a trader. You have some sort of a way to navigate through there. Then you can eliminate time and basically say, well, what events do we need to change this possibility space? And you could think of this as a standard deviation, but personally, I don't think that's the most effective way to do it. I don't think that I know the market herself uses a standard deviation to determine volatility functions and price out the options, which, yes, that's important. But it seems to me that this is not actually the most effective way to determine the boundaries on markets probabilities. The way to determine boundaries, as far as I've seen, the most effective way is to determine where people would become wrong to both sides. If this pushes up and it closes the gap and kept going, I think the bears would accept the fact that they were just wrong. And I think a lot of them, which we can see here, accepted the fact that they were wrong just on a break of the new high. And since we have support and lows, pressing through those lows would probably make the bulls become wrong. And so I think that that is the best way to create the boundaries, only because that seems to be what price respects. I have not seen price respect standard deviations. I have not seen it respect Keltner channels. I have not seen it respect RSIs and CCIs. I have not seen it respect any of those. Even Bollinger Band on the VWAP, which is probably the best Bollinger Band you could calculate, I haven't seen price respecting those bands the way you would expect. And I think it's because the limitations on price are not linear, like over time. They're event based on people, who's here, who's playing. So that's why when I create my possibility space, I use event based limits, not, sequential calculations like a standard deviation or something like that. Though I don't think they're bad. I think they're actually pretty good calculations, and you can use them generally. If you have a good enough standard deviation, it's going to give you an upper bound around here and a lower bound around here, in which case, what's the difference? Who cares? But the problem is the anomaly times, which happen 2 or 3 times a week, where you're like, well, the hard limitation is here and the Bollinger Band is there. And you're accepting excess in risk. You have too much risk because your calculation was too generalized. So, you could do both or one or the other. Bollinger Bands are okay for limitations on your possibility space, but that's the way you build an expectation. Limits and events. And the events are going through time to figure out how you're going to navigate that possibility space, expand it or contract it, those kinds of things. All right, last thing to look at, and then I'll take a look, as some people said some things, is we had compression here in our value area. See how it's tightening up? It means that volume is happening here, and it's saying we're getting more focused. You see, like this. Essentially, when your value, if you're like this, your value area is going to be wide, and then over time it looks like this. Your value area is going to tighten up, and it's because so many orders are happening at some point, so your value area contracts, and you can see that pretty clearly here. That this value area is contracting. There's volume here, and this probably here, maybe here. Well, since it shifted, it was probably right in this area. Volume was happening when we were, right through here. And you can see right there, point of control. So we had some contraction, and now the market is expanding. It's broken out of the value area here, and it's looking to the upside. We do not have nodes on this. To me, this is the shape, not a bunch of little tiny ones. That's silly, a bunch of little. It's like this. So, there's not like a whole lot of low volume nodes or anything to run into on the upside here. It's just, a nice void all the way up to the gap right here. So we're in the void and heading up. I would still love to see a bullish position. I'm wondering, though, at this point, if we're going to get any bullish position before we wipe out the bears. Difficult to trade? Absolutely, because there's no signal, there's no structure. It's just the market pressed the origin position and pushed up. So that's where we are here. We had some high volume, you see, last night. Oh, got an alarm here. High volume last night, which tends to suggest things, but in this instance, because of the events going on, you can see there was a lot of volume around in this move down, which is from a little bit before. And it's just high volume is high volume. You interpret it the way you want. Essentially what it means is the break between here and here, it was a lot of volume to do that. Like that was just a lot of volume. This currently between here and here for a break of this amount of time and this amount of range, this is not a lot of volume to accomplish that work. So you're going to have to interpret that how you want to interpret it. I don't think I have a really great standard rule of thumb for high and low volume. it does tend to be that markets don't like low volume. So I would have to say that that when I see this, I say, well, the market's looking for volume. When you see heavy volume, the market's going to say, oh, there's lots of volume here. Let's keep going. Let's keep looking for volume here because we've, you know, it's commission based. So searching out volume is beneficial and in the program. Okay, so yeah, we're on a break and the market's hunting volume. We don't have a whole lot of volume nodes to stop us from closing a gap. So no problems there. I'm going to switch this over to the bearish position because that's the most recent and it pretty much captures both of them. So that's about where we are. All right, we're marked out. Now the first thing, Matt Mack says, out of curiosity, what's the difference between the Mcclellan tension and the Mcclellan oscillator? If it's something proprietary you developed and can't go into details, I understand. Well, it's a little bit proprietary. Don't I feel important? The Mcclellan oscillator looks at movement in the advanced decline. So if it's a momentum indicator. When the advanced decline goes up like that, this is the advanced decline, the momentum indicator is going to follow. If it goes down, momentum's going to go down. And this is the velocity here. Advanced decline is the data. The sum is it's a tricky little DSP, digital signal processing, and it's our first spot. So if we had S for smooth, and then S prime and S double prime, this is the first derivative of a signal, and this is the second derivative of that signal. So this is essentially the velocity, which the way that they calculate the summation index is not, but it's not really velocity. It's the summation of the signal. So I don't know, we'll just call it the data. This is the velocity, and this is essentially the acceleration, which isn't necessarily true, but you could think of it that way. The oscillator is going to show you sort of, if you think of velocity, that's going to be the best way to look at the oscillator. And and if you look at velocity, you're going to be thinking about acceleration. But because of the complexity of the market and the scale of it, this one's termed velocity because when you watch the indicator, clearly, it just works. So that's the way it is, but they're derivatives of one another, which is what it is. This tension is looking at the possibility space of the advanced decline. So it is looking at, the upper and lower limits, and it's asking questions like probability of going up, probability of going down. And I think I actually got it boiled down pretty elegantly. It tells you what your possibilities are. And essentially where we are located in the possibility space tells you a lot about where we can go in the possibility space. So if tension is running a plus 80, which is insanely high, which would mean this line would be way down here, and that means there's a ton of upside force pushing back. You get a plus 80, there's just a ton of upside force. That it's the probability of continuing that downward tanks. It's just so much upside force. It's beneficial to let that release before trying to pump it down again. And so it's basically saying we're too low in the possibility space. If the bears come in and inject capital, they're going to be flatlining the low. And you cannot have a 100% intention. If that happens, it means that all positions are long or all positions are short and upside down, which is an extremely, extremely dangerous position for markets to be in. So on a daily time frame, the closest we ever get to 100 is around 20%. Because you get any further than that, and too many people are underwater, and the market's going to get explosive because just for the sake of trapping people in and blowing them out for quick cash. And on the 30-minute, we get to about 70%. We have seen 90 during the pandemic crash. We got to 90, but the market cannot hit 100%. If you hit 100%, watch out. the market just broke. We've broken the market. So our limit here is what cannot happen, and that's 100% on either tension. So it's looking at the limits. It's saying, where are we in the possibility space of what can happen? Where this is looking at where, what's the current movement in the market? What direction are we moving? Which relates to tension a lot. They do have relationships to each other naturally. So if you have velocity down all day, every day, all the time, of course, tension is going to move down because the movement is negative. Clearly, we're going to be moving down lower and lower and lower in the possibility space. So they do relate to each other strongly. And decay here relates to this because decay tells you the energy in momentum. So if there's a lot of energy, like we had a lot of positive energy today in the momentum numbers, even though things were moving down, there was clearly a positive force pushing up on the market. And then as this moves around, it's going to affect tension. So these all sort of relate to each other. And then of course, if tension gets really low, it's going to result in positive energy and decay. They all relate to each other in a nice big web of, I don't know, events. So I think that 40% is a little lower than we've seen in a while. You could say, well, we haven't seen down to 40%. That's supporting some of this here. Yeah, possibly. They do relate to each other. I tend to take them in as individual pieces, but this is looking at your energy. I call it decay because the functions I was using were decay functions. Velocity is just derivatives, and possibilities. So those all relate to each other. I personally would never try to interpret one without the others. If I had to pick one, of course I'd pick tension because possibility space is significantly more useful than direction when it comes to figuring out markets. But yeah, they all really relate to each other quite strongly. So okay, so that's where we are right now. I have got to run. I will see you guys later today. I'll pop in and do a video. Thanks for watching.